So in our firm's book, Looking Ahead, you wrote about investment and about investment psychology. Is that right?
Yeah, that's right.
So let's start with the basics, assuming people listening may have all kinds of backgrounds. Some may be more experienced investors. Some may just be getting started. What are some of the things that you would want people sort of across the spectrum of experience to be thinking about with investing?
So there's really no one size fits all approach to investing. The correct strategy is based on your goals and priorities. Do you need immediate access to your money for current spending, or are you saving for an intermediate term need like buying a house or funding your children's college education, or are you growing wealth over a longer period of time for retirement?
Sounds like a lot of people might have more than one of those goals in mind. Is that right?
Yeah. Basically, no one has just one goal for their money. It's always kind of competing interests that you're looking at.
So if you're thinking about different goals with your money, what sort of framework would you usually expect your clients to use or advise them to use?
So the most basic framework I use to help clients understand how to think about investments is based on the time frame for when they need to access the money under basically the expected case, and then also life never happens as you plan. Sometimes you're preparing for a podcast and your computer takes a while to restart. But there's always some kind of surprise that comes up. And so you want to plan for the expected case, but also be prepared for when things come up.
So how does that play into timeframes of investments?
So that is really the way I think about investing. So people think that younger investors are more aggressive than older investors, but it's really the time frame until when you need to access the money that really matters on how aggressive you can be with pursuing a goal.
Makes sense. So then are you going to be sort of thinking about, obviously, retirement for a younger investor is farther away than for an older investor. But even with a younger investor, presumably you might want to buy your first house before you retire. That's sort of the way you're thinking about it?
Exactly. So if I'm trying to invest for one specific goal, that's a near-term goal, I'm not going to invest in the same manner as I would invest if it's a longer-term goal.
So other than time frame, what are some other factors that you're looking at?
So I also try to think about the client's risk tolerance, which is a much harder area to get into because it's this amorphous topic where how do you really characterize what someone's risk tolerance is? It's only after the fact that you really know what their risk tolerance is. It's when the market has been tanking over a recent time frame and the client is panicking, that tells you that the client was probably a little bit too aggressive to begin with. It's natural to have some fear of the fluctuation of the stock market, but really it's if someone cannot handle the fluctuations of the market, they didn't have the proper asset allocation to begin with. And it comes back to understanding that time frames of when you're going to need the money. So again, getting back to that, why do we think about time frames? And why is that kind of the area that I focus on the most when I'm building a financial plan? It's because you don't know what's going to happen in the short term in investing, especially riskier investments. Over shorter periods of time, they're less predictable than over longer periods of time.